Generally speaking, I am a long-term dividend growth investor. So what that means is I'm looking to invest to maximize my dividend income over the long term. So in order to do that, I need to buy stocks that can grow their free cash flow and as a byproduct, grow their dividends at a high rate over time. And this is something I was actually talking about recently over on dividendology.com. The ironic thing about stocks that actually grow their dividend payments over time is they typically outperform other types of stocks. For example, they outperform just dividend payers, the equal-weighted S&P 500, or especially stocks that don't have any change in dividend policy, and especially stocks that cut their dividends. Now, why is it that dividend growers typically outperform? Well, it's a byproduct of one thing: growing free cash flow at a high rate. Stocks that grow free cash flow at a high rate will typically also grow their dividends at a high rate. And one of the stocks that I think is primed to do this over the next decade is ASML. And complete transparency, like always, this is actually a stock that I own in my personal portfolio. If we blow up my growth chart, it's a relatively new position, but I'm already up around 11% on this position. Now, if we look at ASML in the last year, it's actually down by about 22%, and at one point was trading as high as around $1,100 per share. So all the way down to about $747 now. Well, if we look at them year to date though, they are up about 7.78%. Now, there's a lot of people who don't have a complete understanding of the business model behind ASML. And we hear a lot of hype about stocks like Nvidia and Broadcom and Taiwan Semiconductor, and obviously those are massive companies who have had a great run. For example, I own Broadcom, I'm up over 300% on that position, but I still think ASML gets overlooked pretty easily. Now, let me explain why this is. When we think about the stocks we want to own in our portfolio, at the end of the day, a stock's ability to produce outsized returns a lot of the time boils down to its moat. There's the old Warren Buffett quote: "A good business is like a strong castle with a deep moat around it. I want sharks in the moat. I want it untouchable." And here's what gives ASML such a wide moat. They are the only company in the world that is currently creating EUV lithography machines. Now, just how important are these machines to our daily life? Well, let's put it this way. If there's no ASML, there's no EUV lithography. If there's no EUV lithography, there's no TSMC or Intel. And if there's no Taiwan Semiconductors or Intel, there's no Nvidia GPUs, no Apple or Qualcomm chips, no iPhones, no cloud servers, no ChatGPT, no Tesla self-driving tech, no AWS or Azure data centers running the world's AI models. So literally without ASML, the entire way that we live our lives on a day-to-day basis can completely change. So it's obvious, ASML has a massive competitive advantage. They have a wide moat. And with the artificial intelligence market set to grow at a compounded annual growth rate of above 30% through the year 2032, ASML has positioned itself as one of the top stocks to benefit from this secular growth. And I think the management team, I think analysts would agree with that. If we look at the EPS growth projections for ASML over the next 3 to 5 years, we're talking about 18.84% earnings growth projected. So this is a rapidly growing company. It's growing at a very high rate. So one of the questions we do have to ask ourselves is, what are the threat of new entrants to this company? It's obviously a huge benefit that they're the only company in the world creating EUV lithography technology. But what if another company comes along and starts building that exact same thing? What happens to ASML? And this is where it gets important to understand how a company is actually using its capital. If we come up here and plug in ASML to look at their research and development expenses, what we can see is over the past decade, it has grown astronomically. If we look at the most recent quarter, they spent over $1 billion on research and development. And again, this is growing pretty much every single quarter. Now, the end result of them doing this over a long period of time is we can see that semiconductor analysts now believe it would take around a decade and billions of dollars for another company to get to a stage where it could start to compete with ASML. That's just starting to compete with them. So ASML is finally starting to reap the benefits of heavy research and development over the past decade. Again, this is one of the reasons that ASML has such a wide moat. Now let's start to get a better understanding of the general financials of the company, and we'll start by jumping over to the dividend breakdown sheet and plugging in ASML. Now what we can see is ASML has a low starting dividend yield. It's sitting slightly below 1%. But that can be deceiving because this company is growing its dividend at such a fast rate with a 10-year dividend CAGR of above 23.5% in the past 5 years, nearly 19%. And what's great about this is this dividend growth is completely backed by free cash flow growth. So the end result of that is keeping a very low free cash flow payout ratio even though they're growing their dividends at a high rate. So again, it's clear that ASML would fall into this dividend growers category. And real quick, if you want to read an article I recently put out on dividend growth stocks and on dividends in general that includes that research, then you can click the link in the description. But so from a dividend perspective for ASML, things look quite good, and if we look at the recent annual report, we can see management is going to give us even more confidence. They stated down here, we expect to continue to return significant amounts of cash to our shareholders through growing dividends and share buybacks. So it's clear growing the dividends and share buybacks is a clear capital allocation priority for the company. Now, if we go ahead and jump over to our stock screener, we can see I'm going to plug in ASML up here. And like always, you can download any of these spreadsheets and get access to the ticker data add-on in Google Sheets at the link in the description. But what we can see is, like we already know, ASML has grown earnings at a high rate, going from 2014 at $2.74 to in 2024, $19.24. Revenue per share has seen rapid growth, and the same is true with free cash flow per share. But typically, one of the clearest indicators of a high-quality company is going to be their return on invested capital. Now, what is this? Well, this is telling us how profitable are the projects the company is investing their capital into. As a baseline, you typically want to see around 10%, and high-quality companies can typically hit around 20%. But what we can see for ASML over the last 4 years, they've been above 25%, and a couple of these years even above 30%. That's a really good sign, but on top of this, if we jump over to the profitability sheet, we can also see the gross profit ratio is expanding. Margins are expanding. The 10-year average gross profit ratio was around 46.97%. Last year's came in at 51.28%. So growing revenues at a high rate while simultaneously expanding your margins is a phenomenal combination to grow your EPS at a very high rate, and that's exactly what's happened, and it'll probably continue to happen in the future as we're seeing from projections. And on top of all this, ASML has a squeaky clean balance sheet. The debt to assets ratio is just 0.08, so total assets is around $48.5 billion, while total debt is only sitting at $3.6 billion. So the company's sitting in a great position. So it's clear we're talking about a high quality company here. The financials look absolutely phenomenal, and earnings projections look quite good as well. But we have to ask ourselves, is the valuation attractive? At its current prices, could it still make sense to buy this stock? Well, let's go ahead and answer that question. And the first thing that I want to point out is valuing a stock that's growing earnings at as high of a rate as ASML can be interesting. Now, when it comes to a stock like ASML, the valuation can be interesting. Let me show you what I mean. To start off, we can't use a multiples valuation where we compare how the market is valuing companies that are similar in structure because there's not really any companies similar in structure to ASML. We can't really use a dividend discount model because while they are projected to grow their dividend at a high rate, it's difficult to know what that'll look like in the future without more guidance and without knowing exactly how fast they're going to grow their free cash flow. But one of the things we can do is look at this company from a free cash flow perspective. But before we do that, there's actually a better way to value hyper growth stocks. A lot of the times, a better way to look at this is going to be with a reverse discounted cash flow analysis. And what this is going to do is tell us how much free cash flow growth the market is currently pricing into ASML. So for example, the current share price of the stock is around $747, but if we assume 0% growth moving forward, we would come to a reverse DCF price per share of just $338.64. So what this is telling us is the market is pricing in free cash flow growth, but how much? Well, if we bump this up to about 5%, we come to a reverse DCF price per share of $470.51. If we bump it up to 10%, we start getting closer, $656. And if we bump it up to around 12%, maybe even 11.9, you can see we get very close to the current share price. So the market is pricing in about 11.9% free cash flow growth for this stock over the next decade. If you ask me, that projection is on the low end, leading me to believe that this stock is currently undervalued. If we go ahead and jump over to our discounted cash flow analysis, maybe we think it's going to grow at a rate of around 13 or even 14%. What would the end result of that be? Well, we can see after applying a growth rate of 14% to the future free cash flows, finding the present value of those future free cash flows and adding them together, adding the company's cash and cash equivalents and subtracting out total debt to get equity value, dividing by shares outstanding, we come to a DCF price per share of $851.72, which is 14% higher than the current share price. So obviously still, this is going to depend on what type of growth you expect to see from free cash flow, but most would say this is more on the conservative side for this stock over the next decade. But even then, we're coming to an intrinsic value that's a decent bit higher than that current share price. But lastly, what we can do is we can actually project out what our future total returns holding this stock would look like. If we jump over to my sensitivity analysis model and plug in ASML, there's a few different things we have to point out. Now, to start off, when it comes to a sensitivity analysis, in order to project our future total return, we have to be able to project the future earnings growth of the business, and we have to enter a projected PE ratio in the future. So let's start with the PE ratio. What type of PE ratio will the stock be valued at in the future? Well, we can see for the trailing 12 months, it's sitting at about 30, which at first glance seems relatively high, but we have to remember stocks that are growing earnings at a high rate deserve a higher PE ratio. And what we already know about ASML is they're projected to grow them at a very high rate. In fact, if we come down here, we can see one of the cool features of ticker data is it will conglomerate many different analysts' EPS projections over the next few years and average them together. So we can get kind of a middle ground EPS projection moving forward over the next few years. And what we can see is the projected EPS CAGR through the year 2029 for ASML is above 17%. So there's no doubt that ASML warrants a high PE ratio. And in fact, people realize this. The average PE ratio over the last decade was above 35. But we want to be more conservative with our projections like always. So let's assume the PE ratio doesn't go any higher and it doesn't revert back to its mean. We'll go with a 30 PE ratio. Now we need to project our EPS growth rate. And again, let's be more conservative. Maybe we'd go with around 14%. I'll hit enter and all of a sudden you can see what our total returns could potentially look like. By the year 2030, we're talking about a total return of around 106%, not including dividends, and a compounded annual return of close to 13%, which that's a pretty solid compounded annual return. I would take that any day. And keep in mind, this is definitely not pricing in the company's best case situation. Let's keep the EPS growth rate the same, but also assume that the PE ratio reverts back to the average over the last decade. We'll plug in 35.07 and look at just how much this expands our total return. By the year 2030, our total return is now 141% with a compounded return of nearly 16%. So obviously there's a lot of potential here with ASML, and it's hard to argue that there's many companies better positioned to benefit from the exploding AI market. With a complete monopoly on EUV technology and very high barriers to entry to their sector, the company has a clear runway to growth. So even though I was able to add this stock to my portfolio a few months ago at lower prices, I still think it's relatively attractive at current prices. But I will warn you, this stock will be extremely volatile over the next few years. And we've already seen that in the past year. I mean, look at how wide this 52-week range is. The top was $1,110, while the bottom was $578. And we're still closer to the lower end of that 52-week range. So make no doubt about it, buying this stock is a long-term play, but that's something I'm completely fine with. I'm building out a dividend growth portfolio to maximize my dividend income over the long term, and although this stock doesn't pay a lot in dividends right now, I know they're going to grow free cash flow and earnings at such a high rate that their ability to grow dividends at a high rate will continue to increase, and that's exactly what the management team has stated that they're planning to do. So is ASML an interesting stock? The answer is absolutely. Just like any other investment, there are risks. And for example, US and Dutch governments have imposed regulations surrounding exports for this company, specifically to China. So if you buy, be willing to hold for the long term. But go ahead and let me know what you think of this stock in the comments down below. And like always, if you'd like to download any of these automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.